Hi everyone, Jack back with another video, and today I'm going to be doing a little case study on Bill Gates, the Microsoft founder, richest man in the world on and off for most of the last 20 years until being surpassed by Bezos and Musk recently. He has a $23 billion investment portfolio outside of his $124 billion net worth within the Bill and Melinda Gates Foundation. Always interesting to see how the ultra-rich allocate the wealth. This is most likely done with the help of Michael Larson, who's an excellent investor and helped devise this portfolio with the foundation. So as you can see from the pie chart, the company is oddly concentrated in one company in particular, and at 45.5% that is Berkshire Hathaway. Berkshire is the company led by arguably the greatest investor of all time, Warren Buffett. Buffett has averaged stock market returns of 20% since 1959. $100 invested in Buffett's original partnership, which will become integrated with Berkshire, will be worth around $26 million today. That's $100 to $26 million today. Absolutely ridiculous. Even in the last 30 years, the stock is up 6,500%. This is supposed to be when Buffett is out of his prime. Well known that Gates and Buffett are good friends. Obviously, Gates trusts Berkshire and Warren, as the company is worth 45.5% of the portfolio. So nearly half the entire portfolio. That's around $11 billion just in Berkshire stock. And this is the reason why. This graphic is a little outdated on the significant states section. They no longer own the airlines and a few others, but the point remains. You buy Berkshire, you buy an incredible portfolio of robust, wholly owned businesses and a multi-$100 billion stock portfolio controlled predominantly by arguably the greatest investor of all time. Just Berkshire's Apple stake has a market value of over $120 billion today, and that's from a $36 billion initial. That's probably the biggest monetary value returned ever. At around 89 billion. That's absolutely incredible. A business like this is essentially in place of an index fund, in my opinion, so diverse that over time Berkshire should mimic the S&P. The wholly owned businesses are a wide range of companies, some huge, some not so huge, but all really classic Warren Buffett companies, durable, high cash flow businesses that produce cash flow to invest back into the company. Some of the highlights there are Geico, BNSF Railway, Genry. There's Lubrizol, Fruit of the Loom, Dairy Queen. I mean, there's tons of these businesses, and they're all really robust businesses that are classic Warren Buffett picks. So the second company on the list at 12% of the portfolio is Waste Management. Very simple, does what it says on the tin. Offers waste management services to both residential and industrial companies. Very resilient, recession-proof company with a safe, attractive dividend. This theme is going to continue across the portfolio, but this is a classic staple, utility-like business that just keeps on growing at a single-digit clip with great competitive advantage. With its closest competitor, Republic Services, between them they control over 50% of the US waste market. Really built-out infrastructure that's a great competitive advantage and moat over any upstart that wants to get in this business, and the cash flow is excellent. This is a very Buffett-like investment, and you're going to see this is a theme across the portfolio, but many of the companies are like this. The third largest position at 8% of the portfolio is the world's largest equipment manufacturer, Caterpillar. They design, manufacture and sell industrial equipment and machinery for a wide variety of uses. Dividend aristocrat, excellent financial portfolio and financial performance recently, and strong tailwinds behind it if the US, especially if the US Build Back Better bill eventually passes. Extremely well-positioned company to benefit from this, but even without this is a true all-seasons resilient company that is going to be around in 100 years probably, and will be a much bigger entity than it is today. Fourth on the list is Canadian National Railway, which makes up around 6.5% of Gates' portfolio. The reason for this is quite obvious, although it's not a well-known stock. It has insane competitive advantage. Much like Berkshire Hathaway owning BNSF, railroads are expensive to build, and new players rarely enter the market because of the enormous initial outlay. Unsurprisingly, Canadian National Railway has an excellent financial track record and is a safe dividend payer because they can essentially charge what they want. These are near monopoly-like because their infrastructure is just so built out. They're growing the dividend regularly, a safe payout ratio of just 36.5%. So I can imagine this capital returning to shareholders is going to continue for the long term. They have strong revenues at nearly $14 billion. They return capital to shareholders regularly, and they're improving efficiency, and they're not just based in Canada, and they're growing all the time. So this is a really strong business in my opinion. One that I hadn't necessarily heard of, but currently only trades at 23 times earnings, so it's quite an attractive position here. At 4.2% of the portfolio in fifth place is Walmart. I think we're starting to see a pattern here with resilient companies with incredible competitive advantage. In the event of a recession, people still need food. Walmart pays a nice dividend, is super resilient, and grows modestly every year in the single digits. Essential company to the US population, excellent cash flows, and returns a good amount of this to shareholders. Comp sales this year at 8.7% are really impressive considering they're coming off the back of 2020. And e-commerce is a really nice growth engine for this company. Over the longer term, they're growing their e-commerce at incredible rates. That 36.1 billion in operating cash flow is really the reason here. Incredible cash flow and incredible returns to shareholders. Next on the list is Ecolab at 3.9% of the portfolio. Does a bit of everything hygiene related. More important today than ever, as you can imagine. But again, a dividend aristocrat with really strong cash flows, a good balance sheet, and is a necessary business, which makes it super resilient. It's been a necessary business since its founding in 1923, and it will continue to be a necessary business as now more than ever. The theme continues here. Another resilient business with strong finances that's going to be a reasonably good hold in times of recession and is very much a wealth protection company in my opinion. Next on the list at just 3.6% of the portfolio is Microsoft. Of course, Microsoft has to feature here. Gates founded Microsoft, and while he is no longer in charge, perhaps that is for the best. Satya Nadella, since taking over, has proved himself one of the best CEOs in the world. 5 times returns in the last 5 years, which to me is really incredible at this scale with what is now a nearly $2.4 trillion business. Hands in seemingly everything now. Azure forms the backbone of the internet at around 19 or 20% of the cloud computing market and is growing rapidly. It has Windows, Microsoft Office, Xbox, GitHub, LinkedIn, the list goes on and on and on. So diversified, such great tailwinds, a AAA credit rating, so it has a better credit rating than the US government, and it has a ton of cash on the balance sheet. And it pays a reasonable dividend at 0.78% that I can't see going away anytime soon, and returns a tremendous amount to shareholders in the form of stock buybacks. To be honest, it's really hard to see Microsoft being a bad investment for the future, even at this sort of scale, because it just has such great tailwinds behind it, particularly with Microsoft Azure. So this to me is a completely sensible business, and despite it being a bit more growthy than all the other businesses, this is turned into an essential business and is definitely resilient in my opinion. Next on the list at 3.4% of the portfolio is Crown Castle. Not a household name by any means. It owns and operates internet infrastructure all across America, whether that be cell towers, small cell towers, fibre, you name it. It's now an $80 billion company, and it's basically a utility. Internet infrastructure is now completely essential to modern society. And just like Canadian National Railway, it has a wide moat due to the extreme capex that would be required to get the infrastructure they have and to be able to meaningfully compete with them. They have a good dividend, and the stock has actually been returning really well for this sort of industry over the last few years. It's beaten the market in 2021, even at this scale of what is now an $80 billion company. It's resilient and necessary with good tailwinds for the future with the growth of digitalisation and the Internet of Things. This is a really good investment in my opinion and will continue to be. Next on the list is UPS at 1.8% of the portfolio. Again, another essential service. Global logistics and delivery is only going to grow in the future. Growth of e-commerce is a tremendous tailwind for UPS and other providers. Super resilient and a good dividend payer at nearly 2%. It's now a $186 billion company. Really hard to imagine it being smaller in the future in my opinion. They just operate so well, much like some others on this list. The competitive advantage of a huge logistics network is tremendous due to the massive capex outlay needed to build your own. They have over 540,000 employees. They serve 220 plus countries and territories. They have tremendous cash flows. It's just a really, really strong business that is undoubtedly safe, recession proof, and is going to be a bigger company in the near future. So round out the top 10 at 1.7% is Schrodinger. Probably the most interesting company on this list. I hadn't actually heard of it. Schrodinger has developed some software that's a physics-based computational platform that speeds up drug discovery compared to traditional assay and at lower cost. So you can see from the graphic, traditional drug design will be manually synthesizing a wide array of molecules, or in this case 5,000 for this company example, and tested over perhaps 5 years. With Schrodinger, you can narrow this down using it to assess the right candidate and synthesize a lower amount of molecules and test them over a shorter amount of time. It's really the odd man out here. It's just a $2 billion market cap and it is unprofitable. Position sizing is ever near in my opinion, just 1.7%. If Schrodinger went under tomorrow, which even then it's unlikely to do, nothing is really going to happen to the portfolio. But it has huge, huge potential. And it's obviously a cause that Bill and Melinda Gates Foundation are clearly behind. So that rounds out the top 10 in the main analysis. The other 9.4% that remains had some interesting companies there, especially those that are under 1% allocation. Coupang, which is a big Korean e-commerce player, essentially Korean Amazon, but operates in a slightly different way. That's around 0.7% of the portfolio. Has done really badly since its recent IPO, but is a strong business is on my watch list. And Affirm, the big buy now pay later player, partnered with Amazon, which is obviously an excellent tailwind, and there are some strong tailwinds for buy now, pay later industry. But obviously they're both odd men out here, especially a firm which is price sales is around 30 at the minute, I think. With that being said, these are all about position size in here, under 1%, so essentially doesn't matter to the overall performance of the portfolio, but if they explode, and they become meaningful positions. Clearly, Gates' portfolio prioritises low beta companies, prioritises wealth protection, resiliency, strong dividends that pay year in, year out, and all-weather performance. I think this will perhaps beat the S&P over the longer period, but will do so with safety and lack of volatility. Overall, it seems to me like a really well-balanced portfolio for this purpose. Of course, for the young people, me included, it's a bit too conservative, and for anyone with a growth priority, this is really not the type of portfolio you want, in my opinion. That being said, for those perhaps later in life who are more focused on wealth protection and income, this seems like an excellent model to follow, in my opinion. So definitely some interesting companies here, particularly, for example, Microsoft, obviously an interesting company that should have a place or should be considered in everyone's portfolio. I really like Berkshire Hathaway. Having not researched it before, I like Canadian Railway. I'll definitely be doing some deeper research on Schrodinger, because I think that's a really interesting business. And that'll round it out. So I'd appreciate if you could like and subscribe if you enjoyed the video. Thanks.